Hello, everyone, and thank you for joining us today for this COVID-19 webinar. So on behalf of the presenters, we'd like to thank all of you for joining us today. We look forward to a lively discussion on alternative lending, what you need to know, and how it can help your clients. I'd like to start by having each of our panelists introduce themselves, talk about their company, and what lending opportunity they will be talking about today. So I'd like to first introduce Meredith Carter, President and CEO of Context Business Lending, LLC. Meredith?
Thank you, Ken, and thank you to all of you on the phone for the opportunity to be here with you today. My name is Meredith Carter, and I'm President and CEO of Context Business Lending. And I started my career as a lawyer in private practice for 7 years in Wilmington, Delaware, where I was focused on corporate transactional law and corporate litigation. And prior to Context, I helped grow and sell a patent litigation funding business. So I've gone from one form of niche specialty finance to another. And now at Context Business Lending, we are a family office-backed specialty finance company that focuses on providing working capital to middle market, mostly privately held companies. And we provide between $1 million and $25 million in revolving lines of credit secured by the company's assets. We lend against the company's accounts receivable, inventory, machinery and equipment, and owner-occupied commercial real estate to provide liquidity to these companies.
Thank you, Meredith. I'd like to now introduce Paul Sheldiner, Executive Vice President of Rosenthal & Rosenthal. Paul?
Thanks again, Ken. I appreciate everybody asking us to be involved today and taking part in the webinar. Again, my name's Paul Sheldiner. I'm EVP and Division Manager for Rosenthal & Rosenthal's Purchase Order Financing Division. Rosenthal & Rosenthal is an 82-year-old family-owned and operated commercial finance company. We're probably best known as a factoring company. We're the largest privately held factor in the United States. We factor, our volume is probably about 12 billion in annual volume that we factor, primarily to companies in the consumer product space. We also have an asset-based lending division that does revolving lines of credit against for working capital for manufacturers, service companies, and distributors. And then the division I specifically manage is the Purchase Order Financing Division, and that is a bridge capital tool, transaction-oriented capital tool, primarily for companies who are importers, wholesalers, manufacturing businesses, not service companies, that get large sales opportunities and contracts and need additional working capital over and above what they would get from their traditional senior lending source in order to execute on these contracts that require specifically pre-sold inventory financing. Deal size we look at is typically anywhere from $500,000 to $25 million is a funding size as a credit facility. We typically look at, I would say our sweet spot probably is companies that require somewhere between 1 million and 10 million on average.
Thank you, Paul. I'd like to now turn over to Paul Flynn, President and CEO of BDC Capital and New England Certified Development Corp. Paul?
Kenny, thanks for inviting me here today. I hope everybody is doing well and your families are safe. Again, my name is Paul Flynn. I'm the President and CEO of BDC Capital. I come from the banking industry. I spent many years in the commercial lending field, principally as an asset-based lender. And then after nearly 28 years in the commercial lending industry, my peers claim that I made it over the fence when I joined BDC Capital nearly 7 years ago. So BDC Capital is an economic development company. We're controlled and funded by 38 member banks. We've been around since 1953. And we continue to evolve to meet the needs of our banking partners in the business community. So today, we offer a broad array of products, everything from factoring to ABL, working capital lines of credit, senior, junior term debt, mezzanine investments or subordinated debt, and we are an SBA lender, including the 7A and 504 program. We are the group that provides the missing piece of capital that's often necessary to complete a deal. You can think of us as the institution that fills the gaps, so to speak. Whether it's a highly leveraged balance sheet, inadequate collateral coverage, or thin cash flow, there's a good chance we can customize a solution to meet the needs of your client. Our product line is available throughout all the New England states, and the mezzanine product, which I'm going to be addressing in more detail today, is also available in upstate New York through our partnership with NYBDC. So we provide capital solutions ranging in the $1 to $5 million space. We can deliver much larger credit facilities if required. We're based in Wakefield. We've got a staff of about 30 folks. Many are seasoned veterans coming from the ABL and leveraged cash flow sectors. And to just give a little more context, we have roughly about $750 million under management through all of our various programs. And last year we helped, again, through all of our programs, about 400 businesses. So it's a pretty broad product offering from small business all the way up to mezzanine. Kenny, that's my nickel tour of BDC. And again, thanks for inviting me here today.
Thank you, Paul. Thank you. Now I'd like to turn it over to Pat Lee, Managing Director and Head of Lender Finance within the Asset-Based Lending Group at People's United Bank. Pat.
Thank you, Ken, and thanks for inviting me here today. So good afternoon. My name is Pat Lee. I'm presently Managing Director and Head of Lender Finance for People's United Bank. People's, for those of you who may not know, is an approximately $60 billion regional bank. So I represent the regulated side of the house on this panel. We're headquartered in Bridgeport, Connecticut, with approximately 175-year history going back. Our core footprint runs from Maine to Virginia, with national operations in leasing, mortgage warehouse lending, and lender finance, which I lead. Over the course of my career and multiple economic cycles and events, I focused on various parts of the middle market in commercial lending. So I bring perspectives from significant leverage cash flow lending experience, to which I'll speak today, as well as regulated bank lending through cycles, which I think is pertinent as part of this discussion. So again, happy to be here, and finally a sunny day for most of us.
Well, thank you to all of you for joining us today. It means a lot to us. And I'm going to hand it now over to Mark O'Connell, who's going to take us through some questions. Mark?
Hi, Ken. Thank you. And good afternoon, everybody. I wanted to start with asking each of you to give us a brief description of the typical client that approaches you for financing in your world. And what are particular business types or reasons for them selecting you specifically? And I thought we would start off with Paul from Rosenthal.
Okay, great. Mark, thank you very much. So I'm going to focus mainly on the factoring and PO financing aspects of why people would approach us as opposed to ABL and other products. But just to let everybody know, typically we're usually looking at entrepreneurs, closely held businesses for the most part. Frequently, they are importers, distributors, light manufacturing businesses, specifically consumer and industrial products is where we see most of the companies that come our way. And they come to us typically, usually these are companies that have seasonality or are cyclical in nature. They're undercapitalized, typically relative to the amount of volume they are doing or could be doing. They're probably leveraged as well. And they need support, particularly working capital support, to drive the cash flow needs of the business. So they're looking to leverage assets. With respect to factoring, factoring is a well-known, one of the oldest financing tools probably known to commerce. It starts with lending on receivables, looking at customer credit, meaning the debtors or clients, customers that our clients sell to for the credit worthiness. We typically offer factoring as a non-recourse product, so we're taking the credit risk. And we're also providing, beside the loans against receivables and inventory, and sometimes trademarks and brands, we're also providing, on the factoring side, infrastructure support. Think of it as outsourcing the accounts receivable management function for a business, which is in these times is even more critical because what we're providing there is all the back office functions of basically processing the receivables, processing the sales invoices, doing the cash application, providing collection efforts, and also providing effectively credit insurance protection, because again, we are offering a non-recourse factoring product where if we assume the risk of the client, the customer that our client might be selling to, and they don't pay due to financial inability to pay, we assume that risk because that's part of the factoring service. In PO financing, we're looking at companies, again, same credit profile, except what's happening is there's some driver in the business in that they're getting larger orders, larger sales opportunities, contracts, distribution agreements, where there's a real need for a inventory financing over and above what maybe an asset-based lender or factor might provide, where maybe they're getting up to 50 or 60% against inventory. They have a cap in the facility in terms of how much they can borrow on inventory. PO financing is very transactional. Think of it as transactional equity, really as an alternative to a company raising more permanent equity, where they can use it to specifically fund the full purchase price of pre-sold goods. So think of it as 100% advance rate on the inventory required to fill known sales. And the beauty of it is that the PO financing product can also work in tandem with other sources of lending, whether it's banks, other asset-based lenders, or other factoring companies, which I've done most of my career. Originally, I started out as a CPA myself and got into the asset-based financing world, and always worked a lot with these types of consumer products companies in particular that would need this form of financing. So it's very flexible. You can kind of come in and out of PO financing as you need it. So it's a good tool for the company who, again, may not be ready to give away equity, but needs more incremental capital to achieve sales opportunities that it has in its space.
That's terrific, Paul. Thank you. Hi, Meredith. How are you today?
Doing well. How are you?
Good. You think you could tackle the same question for us, please?
I think so. Yeah. So similar to factoring and PO financing, when you have clients that are in a situation where they or their investors don't want to add additional capital and they don't want to dilute their equity positions, asset-based lending could be a good solution for them. And asset-based lending really picks up where factoring leaves off. So therefore, we're best fit for companies who want to leverage additional assets above and beyond just accounts receivable, so they get additional availability. And because the risk is a little bit lower, they're here with a little bit lower rate. In asset-based lending, clients keep their assets, and we lend against them to provide them liquidity. So they could really make use of what they have without having to cash out. I like to describe our borrowers as companies that are temporarily but not inherently unbankable. Actually, every company that's ever worked with us has graduated to a bank upon leaving us. Typically, our clients are companies that have gone through a rough patch of some sort, or rapid growth, or they're in a turnaround, and they need access to working capital. Their companies banks won't lend to for reasons including they don't have 3 years of history, they've had a significant revenue, they're in a position where they need additional flexibility, like they want to borrow frequently, or they can't meet financial covenants or availability blocks. They could be highly seasonal businesses where they're using some of their line part of the year and none of it the other part. Again, a turnaround, merger or acquisition, an inventory heavy business, like online, anyone sells through Amazon, for example, or they're in an industry that banks don't care for typically, like firearms or CBD companies, which we also lend to.
That's terrific, Meredith. Thank you so much. Paul, I'm sorry, Pat, could you give us your thoughts on this, please?
Sure, Mark. Thank you. In terms of cash flow lending, I guess I drew the distinction at the outset in terms of being part of a regulated bank. Something to point out on that front is that subsequent to the Great Recession of 08, 09, the regulators for banks introduced leverage lending guidelines that limit the leverage levels and require repayment within certain specified parameters for regulated bank entities. As a result of that, it's worth noting that significant amounts of middle market cash flow lending today reside outside the regulated bank environment. That said, borrowers who seek cash flow loans, they often do so to maximize leverage or because they may have asset-light businesses for whom ABL structures or other solutions are not optimal. Cash flow lenders often do work with ABL lenders, however, under bifurcated collateral structures. So the ABL lenders might get the working capital assets while the cash flow term loan lenders would receive all other assets. Credit metrics for leveraged cash flow loans typically reflect consistent and profitable operating performance, pro forma ability to service the debt under proposed structure and on a look-back basis. Strong borrowers in this category typically fit well into either a diversified or fundamental credit box, which, suffice to say, in each instance offer attributes that provide meaningful barriers to competitive entry that would result in performance erosion. Leveraged cash flow lending is cyclical, however, so coming out of a recessionary environment, leverage levels and loan structures are relatively conservative with pricing relatively high. That's what we should look for coming out of the current environment, I think. As recovery extends, leverage tends to increase, structures loosen, and price compresses. Interestingly, yesterday's Wall Street Journal had an article called "Pandemic Triggers a Wave of Distress: Bankruptcy in Corporate America" that highlighted this. They noted that leverage in LBOs in 2019 averaged 5.93 times, the highest since pre-recession 2007 at 6.23 times. While 85% of leveraged loans in 2019 were what they call covenant light, meaning no affirmative financial performance-based covenants such as fixed charge. This compares to only 10% in 2010 coming out of the last recession. So in summary, I'd say that when faced with underwriting challenges in assessing cash flow visibility as we would face today in the new world, leveraged cash flow lenders will be circumspect and realistically relatively conservative. This will be compounded as lenders inevitably work through existing portfolio challenges and look to preserve capital.
That's terrific, Pat. Thank you so much. Hi, Paul. Could you answer the same questions, please, for us?
Sure things, Mark. And I'm going to dovetail a lot on what Pat had to say. I mean, basically, we are we're the junior capital. We're behind the bank senior facility. So it's, I guess you'd call it some semi-permanent form of capital. We first introduced our mezzanine product about 20 years ago, and at that time, there weren't many players focused on companies looking for $1 to $5 million in junior capital. You fast forward today, and we're in the midst of investing our fourth fund, and banks are our primary source of investment capital. Again, our mezzanine fund is geared for the lower middle market. We're opportunistic and industry agnostic. We typically make investments ranging from $1 to $5 million in established businesses. We don't provide early stage or seed capital. We focus on companies with an established cash flow. The capital is typically used to accelerate sales growth, facilitate some sort of a generational transfer, address a cyclical event, which we'll talk about more later on, where we see a business going, or used as part of an M&A transaction. We generally invest alongside a bank credit facility, and quite often we partner with ABL lenders. Businesses can be privately owned, or we typically get involved with a lot of small sponsor or family office type situations. At the lower end of the middle market, it's kind of what Pat was talking about. You're really betting on the success of the jockey, so to speak. So we focus on the management team and their expertise or experience. And usually the companies that we invest in have some unique or defensible niche that really can be manifested by looking at their gross margin. Usually it's an above average industry gross margin. It really can be in any industry. We've done deals recently in food and shoes and technology, et cetera, but they all have clearly demonstrated some kind of unique or proprietary characteristic that makes their cash flow durable, sustainable, and most importantly, recurring. And I'll touch a little bit later on some of the other aspects of structuring.
That's great. Thank you, Paul. A follow-up question, and let's go in the same order, Paul. Can you talk a little bit more about how you work with your clients, structuring, leveraging capacity, loan covenants, et cetera?
Same, Paul Schaldiner or Paul Flynn there, Mark?
Paul Schaldiner.
Okay, got it. Okay. So thinking of on factoring, what we look at is obviously We look at the historical receivable performance. So there we're looking at what has the historic dilution been. Dilution meaning anything that impacts the ultimate collection of the receivable, meaning returns, allowances, unauthorized discounts. So historically, obviously, the lower the dilution that a company experiences that requires factoring means the higher the advance rates can be on the receivable financing, meaning traditionally most people you would see is generally 80, 85%. In certain cases, if the dilution is less than 2%, we may go as high as 90%. Conversely, on the AR, conversely, the higher the dilution, the lower the advance rate on receivables. We look at concentration. Obviously, in the retail world today, with everything going on, concentration has become more and more of an issue, and that's a very important piece. So in terms of the risk that we perceive, obviously we have to look and see if we can credit approve the accounts, because again, remember I said earlier, we're a non-recourse factor, meaning we take the credit risk of the underlying debtors that our clients sell to. So we look at spread, we look at concentration, we look at the ability to approve the amounts that are required for that customer. On inventory, you're looking at obviously what the nature of the inventory, the concentration of SKUs, is it fad oriented, seasonal, subject to obsolescence. We look at the need possibly for an appraisal of that inventory. So those are some things in terms of structure. We're really not covenant driven. There really is no covenants in factoring. So that's definitely not a part of our structure. Leverage, again, really not looking at leverage. We're looking at the performance of the collateral and our ability to lend into the collateral. With PO financing, you're looking at typically, again, our clients have to have the ability to execute on the transactions. We have to feel that they understand if they're an importer. Do they understand and can they show us that they've actually imported a similar product? Are they familiar with the logistics, inspection, quality control? Are they selling to a credit approved customer? Meaning if I'm working either as a client of mine in factoring where I'm providing PO financing support, we're looking at the credit in our factoring division. But if I'm teaming up with other third-party lenders, which I do frequently, then I want to know that that lender is going to consider that account to be an eligible receivable. So if we provide the PO financing and provide the funding of the cost of the goods, that when it does become a receivable, that other lender will take us out and advance on the AR as our repayment source. So again, we look at making sure the goods are pre-sold, making sure there's a quality control and inspection that can be done of the goods. We're typically looking at, again, making sure that delivery dates can be met. We're verifying purchase orders. We're making sure that timeframes and, again, the client can execute. Because ultimately, that's what it comes down to. It comes down in PO financing, and it's on the ability of the client to execute on the transactions.
That's terrific, Paul. Thank you. Meredith?
Sure. So our asset-based loans are structured as revolvers. As I mentioned earlier, we don't have financial covenants or availability blocks in our agreements. Instead, to get comfortable with the collateral, we're true ABL lenders and typically require 3 to 4 field exams a year, as well as periodic inventory and real estate appraisals. We require lock boxes and full dominion of cash, and our borrowers submit borrowing-based calculations every time they want to borrow, or at least weekly. So we calculate their availability based on the assets they have available, and our typical advance rates are about 85% on accounts receivable and 50 to 60% in each of inventory, machinery and equipment, and commercial real estate. And I'll get into a little bit what we look at in diligence a little bit later in light of COVID.
Great, thank you so much. Pat?
Sorry about that. Was on mute there for a second. So yeah, as I mentioned earlier, in terms of cash flow lending, it's a cyclical market. I guess the key metric here would be enterprise value. And as you would expect in terms of cash flows, enterprise value typically being established based upon a multiple of cash flow in a business. Given the current environment, many, if not most instances today, you're going to have a contraction in enterprise value. So it puts pressure on the capital structure. and you know, you couple that with, I guess, a willingness of lenders, senior cash flow lenders, to do a lower multiple in general, and it creates a very distinct difference from period to period. So if you went back to 2011, for example, you might have senior bank or senior cash flow leverage even between 2.5 to 3 times in a capital structure, and you'd have pro forma equity in a capital structure of 40% or more. Whereas in 2019, those numbers changed significantly to where you had a 5 to 6 times multiple of EBITDA, perhaps on the debt side, and a 30% or perhaps less in terms of equity contribution in a cap structure. So I guess in today's lending environment for cash flow lenders, to the extent deals get done, they would reflect lower leverage, tighter covenant structures in terms of multiple, perhaps performance, fixed charge coverage, leverage, et cetera, covenant structures, and then of course higher capital, cost of capital as well.
That's terrific, Pat. Thank you so much. And Paul, can you give us your thoughts?
Sure thing. You know, we're looking at leverage multiples, at least historically, that were total leverage was running in the 3 to 5 range, with scale, really, you know, customers scale, customer concentration concerns, and their limited access to capital being the real governor. So in cases where there's an ABL line that's closely followed, we might allow leverage to be a little higher and sit behind that. We typically structure our deals as a 5-year note. We target a mid to high teen all-in return, depending upon the risk profile and the situation. Generally, our notes are structured with a current fixed current pay coupon, say 10 to 12%, and we reach our all-in target return using a warrant. But to be honest with you, more often than not, a royalty. The royalty is based on some percentage of sales. It's paid quarterly. We've been doing it longer than Shark Tank has, but it's been successful over 25 years. The royalty typically ranges from 5 to 25 basis points. It all depends upon the size of and nature of the business. And we find in the lower end of the middle market, most businesses do not go public or seek a liquidity event, so the royalty model is preferred. The royalty is non-dilutive, it's tax deductible, and it removes the whole negotiation about valuation, exit events, and puts, etc. Over the life of our investments, we do like to see some type of principal amortization. There's usually an interest-only provision at the outset of the deal, and we like to see some type of meaningful principal amortization to begin, usually by month 24. We like this approach. It seems to provide business owners with more options at maturity. Our investments are typically secured but subordinate to a bank, and financial covenants usually mirror those of the bank, as we're cross-defaulted with those. We generally have an intercreditor with the senior lender, and that usually includes a standstill provision.
That's terrific, Paul. Information. And thanks to everybody so far. It's been really informative. We'd like to move on to the impact COVID has had on your individual business. So let me ask this of you, Meredith. Are certain types of alternative lending more popular in this environment? I know I've seen you do quite a few deals. Is it easier to get the middle market business during this time?
Yeah, I would say it's changed a little bit in order because they require the shortest time to close. I would say merchant cash advance, factoring, and then ABL. The rates would also be different. So in these products, you would see merchant cash advance rates sometimes in the 30s, and then ABL going down to around 8%. So it really depends how quickly your clients need funding. And sometimes, as was stated earlier, it would be good to work with someone like Rosenthal on the PO side, while another ABL lender is in diligence if they need immediate liquidity, and then they can convert to an ABL later at a lower rate. I also think it depends on the types of companies that end up getting the SBA funding and those who still need funding. So we're all sort of waiting to see what that delta looks like, and those companies are waiting to see what they're eligible for before seeking alternative financing.
Oh, that's great. Thank you, Meredith. Paul, can you take a stab at that, please?
Sure. So COVID definitely, this whole crisis, because we do a lot in the consumer goods space, obviously with clients selling into retail channel of distribution, It's created, certainly, we have to be a very patient lender right now. There's no doubt about it, because as you know, very few retailers are taking goods and shipping, taking goods in. So it's something obviously that we're supporting our clients with, to see them through this, and get them through this period as best as possible. So I think that's had the biggest impact in terms of what we see. Obviously, from a timing perspective, our PO Finance product, typically we can be in place usually within a 7 to 10 business day time frame if the stars align. I would say 2 weeks is typical. And then factoring, probably it's a 3 to 4 week process, because there still is due diligence that needs to get done. The other aspect, interesting enough, what we're seeing in the COVID side right now is an inordinate number of requests for clients, companies that are selling into this personal protection equipment space, masks, gowns, hand sanitizer, tremendous amounts. A lot of vetting need to get done. These are typically big numbers that we're seeing. I would tell you that one of the challenges is making sure that the company or entrepreneur, because these are entrepreneurs at the heart of this, know what they're doing. So we look at a lot, we get a lot of requests, and we have a certain playbook and criteria that a company needs to meet in order to qualify for that. So I think that's really where the COVID has had the most impact. But as far as everything else, I mean, obviously they're going for the different, the PPE, the loans that they're going, and all the government programs. We're encouraging our clients to do that to the maximum that they can. But again, as a non-bank lender, we're used to dealing with companies that need additional support and rehabilitation where needed.
That's terrific. Thank you, Paul. Next question I'd like to address to you, Pat. Are you expecting to see peaks in certain industries over others as to who would be seeking to work with you?
Yeah, Mark. So I guess the way I would frame that is it would be more of a negative kind of view. So there's going to be, in the cash flow world at least, there's going to be those industries that we've all seen really suffering in today's environment that are going to be challenged to obtain cash flow financing. And those would include things like transportation, leisure, more discretionary type things, restaurants, et cetera. And they're not, I wouldn't say they would work well in a current environment like this. So in answer to the question, more of in a negative sense, I guess that's the way I would look at that. Some of the other things that obviously are going to be impacted, automotives, right? You go from somewhere around 17 million units a year down to somewhere sub 10 million, I guess they're projecting. It's going to have a dramatic impact in trying to lend into that on a cash flow basis. So yeah, I think that's going to be a big diligence item for cash flow lenders here, is going to be what industries, I think as Paul Flynn said at the outset, recurring revenue and income streams, are being generated in these businesses. And so that's going to be a big part of the underwriting challenge.
Oh, that's great. Thank you, Pat. And Meredith, what kind of deals are you seeing these days?
We're seeing a lot of food packagers and distributors. We're lucky enough to have a game and puzzle manufacturer in our portfolio, and they've never been doing better with everyone at home. Again, anything selling mostly online, like Amazon distribution companies. Our firearm clients are doing well. A lot of manufacturers, including a lot of parts manufacturers. And to add on to what's been said, what Pat just said about what we're looking for in diligence, we've always been looking at, of course, financial statements and AR and AP agings, but in this new COVID world, we'll be paying closer attention to their 13-week updated cash flows, because the ones they prepared pre-COVID are pretty much worthless at this point. The 13-week cash flows need to be based on borrowing base availabilities. So, for example, if they have $100,000 in AR and we're advancing 85 cents on the dollar, the cash flow would need to reflect 85,000 on the borrowing base. And then also, I think reporting and keeping things up to date could be an issue for them. So we look at their ability to do that. In the past, you can make inferences from past performance, but now they really need to be up to date as yesterday. We also look at year-to-date performance, whether they're an essential business, the net orderly liquidation value of inventory, whether in the event of default, we would actually be able to sell the inventory because of the same closures that may be affecting them, concentration risk. We're looking at businesses that have a little less machinery and equipment and real estate than we typically look at. We look at their ability to get credit insurance, again, management performance, the recent COVID impact on sales, have their AR collections patterns changed? Do they have any change in borrowing needs or liquidity? Do they have key man life insurance? What possible long-term effects might COVID have on sales? What has their impact of COVID been on customers and vendors? What has the supply chain risk been, and has it happened yet? And finally, what efforts have they made to reduce expenditures in light of the pandemic?
Oh, that's terrific, Meredith. Thank you. And I think I'll turn it over to Ken. Ken?
Thank you, Mark. And as you can see just from some of these questions, this is a certain space of lending that we don't see a lot with our clients. So hopefully this is finding it informative so far. I know we've been kind of going a little fast with some of the questions. I'm going to try to combine some with Paul Schuldiner and Paul Flynn. As we look at this economic shutdown, and we've heard a lot of the different challenges like Meredith talked about. What other things do you guys think your clients will face in navigating and obtaining financing through this time? And maybe even talk about the period of time you think you'll start to see the surge coming towards your type of lending in your space. So I'll start with Paul Schuldiner first.
So thanks, Ken. So I would tell you that obviously I think the biggest challenge for our clients in the consumer products, and one of the things obviously is apparel, footwear, other aspects are very much challenged right now. A lot of the sales and orders that people thought that they had for spring and even going into looking into fall have to be revetted significantly. There was comment, I think Meredith earlier, about the 13-week cash flow. This is very similar. We are looking at the 13-week cash flows very closely to understand and really challenge the client's assumptions with respect to visibility into revenue. And that's the hardest aspect right now. We are asset-based lenders, all of us, other than Pat, who's cash flow, but we are at the hard asset-based lenders, and it's about asset creation and asset performance. So I think that's the thing that clients it's the visibility into revenue, I think, is one of the challenges that we're seeing, particularly in the consumer products landscape. I would tell you, though, where we've had some success recently is food and beverage, beverage packaging companies. That's been an uptick in our business, both in factoring and PO financing. So I think those are going to be some good areas. I think the medical products and health products are also going to be good areas, and beauty. Those are some good areas, I think, to see with respect to obtaining adequate financing in this marketplace at this point in time.
Paul, how do you see this from your perspective with with the mezzanine type financing? When do you think you might start to see your surge coming through, and the things you're going to have to look at to try to get around this?
Yeah, Kenny, interesting enough, there are segments doing quite well still. So we've actually closed just in the last couple of weeks a few deals. To no surprise, one is in a food distribution business. They quickly pivoted away from the restaurant space, but they're augmenting the other broadline distributors and supplying product to supermarkets. We also have a consumer company that has a very strong direct to business to consumer internet channel, and despite everything going on here, they've done very well. So, believe it or not, we have a pool company, a large distributor of pool supplies, and with social distancing and everybody staying at home, guess what? The pools are opening. So if the weather permits, but they are opening and people are paying those bills and the receivables are performing and the company's doing remarkably well. But as we look ahead, I think the busy time for us is really going to be late this summer or I should say the fall and early next year. There's so much uncertainty. Nobody can honestly and accurately forecast all the ripple effects from this COVID-19 event. If you knew how that crystal ball was going to play out, I don't think you'd be sitting here today. But I do think that a lot of business owners are going to confront a lot of working capital issues and they're going to burn dollars on think about just permanently extended receivables, bad debts, obsolete, spoiled inventory, mundane stuff, broken equipment, all the stuff you could think about when you go into reopen or restart a business is going to consume cash. So once these practical but critical issues are addressed and growth resumes, businesses are going to need capital. It might come from the working capital lines of credit, as we've heard from a lot of the ABL folks here, but you're probably going to see more restricted terms of availability. So whatever formula you might apply, the reciprocal of those advance rates are going to need to be funded either through profitable operations or other forms of capital. So I think this scenario is going to play out repeatedly, and owners will have to make some decisions on how to fund the restart and growth of their business. They can obviously, dip into their own wells if necessary and put in capital, or they're going to look to other providers. Banks will probably provide some piece, but there's going to be a missing gap, and I think that's where our mezz is going to come into play. One other consideration, real quick, we've been reading about $600 billion of PPP loans and all these other disaster relief programs, but I think most of us have been around long enough to realize there's no such thing as a free lunch. At some point in time, the government and the banks are going to become a lot less accommodative. Some of this may be forgiven, but you know what? There will be a day when this is going to have to be settled or refinanced, and guess what? You're going to probably need private forms of capital to take care of those needs.
Great, thank you. Just maybe quickly, because I know, Meredith, you talked a little bit about that with Mark and Pat here. We have a lot of people on this phone and work with their clients often to try to assist them, making sure that they can get the right information to you for completing your underwriting. Financial statements, tax returns, balance sheets, year-to-date forecasts. I heard 13-week cash flows. So maybe even Pat or Meredith, is there anything else you could think of from a financial statement perspective you think might be needed?
Sure. Pat, do you want to go first?
Well, I guess from a leverage cash flow standpoint, I would just say, collateral information is less critical. You try to assess what's an enterprise value for a given business and over the cycle sort of normalized, I guess. And what does that entail from a diligence perspective? It's quality of earnings analysis around historical financials, for example, where they'll do stress around sort of, assuming certain parts of the business may not exist going forward or what have you. So it's a third-party item typically, and then industry dynamics and positioning, again, often performed by third-party analysis, but really assessing that, I think that's going to be two critical elements for cash flow lenders.
Hey, Kenny, it's Paul.
Add on.
Go ahead, Meredith. Go ahead.
To add on to the long list of, from NASA-based perspective, what we look like, we're comfortable these days. There's been a change with virtual appraisals and field exams. And the way we approach it is we look at the numbers that come back conservatively. So if there's normally a 60% advance rate, it might be 50. And now we're looking at the credit of the company even more than in the past. So if we do desktop or virtual appraisals, we'll fall back on cash flow performance. We're most likely to be comfortable with break-even or profitable companies than those that are underwater. We also look at the ease and possibility of liquidating if need be. We're a little less keen on large amounts of inventory. Typically, we can go as high as 4-to-1 inventory to AR in case we need to step into their shoes to sell the inventory. And from the credit insurance world, what we're hearing is they are still underwriting, but they're much more conservative and charging more than they typically do. From the financial perspective, while we would love to look at audited and reviewed financials all the time, we can make do with internals, and we understand if the 2019 tax returns are a little late. So yeah, that's about what has changed with that.
Kenny, it's Paul. Real quick to dovetail on what Meredith and Pat had to say. The other thing I think where your team can be very helpful to us is we already touched on the quality of earnings, but we're doing spending an awful lot of time looking at break-even analysis. and contingency, obviously scenario planning. So, does a company have that proverbial Alpha Bravo Charlie plan, the 10, 20, 40% reduction in revenues? How do they react? So I think that type of thought-provoking questions on your end, if not the production of that work, would be very, very helpful to the lending community.
And I want to thank everybody for joining us today, and especially to our panel. I can't thank you enough for taking time out of your busy schedules to help us.